Hello guys. In today's video, we will together venture into the mind of Warren Buffett and uncover 9 of his unique stock psychologies which helped him become one of history's most revered investors. Let's dive in. Warren Buffett is often referred to as the Oracle of Omaha. He's widely recognized as one of the best investors of all time. In the world of investing, if you understand the psychology behind Buffett's stock picks, you will be equipped with valuable insights and lessons. It doesn't matter if you're a seasoned investor or a beginner, so fasten your seatbelts and get prepared to gain valuable insights that go beyond financial charts and balance sheets. Unravel the emotions, the principles, and the unwavering beliefs that set him apart as a true investment guru. Number 1. Understanding the business. Understanding a business is the foundation of Warren Buffett's investment strategy. It allows him to make well-informed and rational decisions. When you understand a business, it enables you to identify where it has a durable competitive advantage. What this basically means is that you will be able to verify if the particular business can sustain itself in times of heavy competition or not. Buffett famously believes that the management of a business plays a crucial role in its success. When you learn about a business, you will not also be able to judge the effectiveness of its management. This judgment will help you make an assumption about the company's future growth and prospects, and thus will help you decide whether to invest or not. Number 2, investing is a long-term process. Guys, it's very important for you to understand that investing is indeed a long process. When you accept this, it will help you maintain realistic expectations about your potential returns. While the stock market can deliver impressive gains over time, it is subject to short-term volatility. Understanding that will prevent you from expecting quick riches and reduce your urge to engage in risky speculation. Long-term investing will also allow you to take advantage of the compounding effect. Are you wondering what the compounding effect is? Well, let me explain it to you. Imagine it like a small snowball rolling down from the hills. As it keeps rolling, it keeps collecting more and more snow. This process makes the initially small snowball turn into a giant mass of snow. So, in a similar manner, you basically earn a certain amount of interest or return on the initial investment, and then you reinvest that earning to further generate additional earnings. This, my friends, was the compounding effect. If you want to learn more about it, we have made a separate video about the power of compounding. You can find the link in the description. Number 3, price is what you pay, value is what you get. In this approach, Buffett tells you to identify companies whose intrinsic value is higher than their current market price. For the ones wondering what intrinsic value is, let me define it for you. Intrinsic value is a measure of what an asset is worth. When you compare the intrinsic value of an investment with its market price, you get an idea of whether the investment is overvalued or undervalued. Through this psychology, Buffett basically asks you to look for undervalued stocks and hold them for a long time. Are you wondering how this will help you? Well, holding your investments for a long term will allow the market to eventually recognize and reflect their true value. This only means a good return for you. Guys, while you follow this technique, it's also important to know that the market doesn't always reflect the true intrinsic value in the short term due to various reasons. Number 4, diversification. As we've already quite a lot of times in our other videos, diversification is one of the best techniques for risk management. We now know that a diversified portfolio is the most stable and consistent in terms of returns. The question at hand is, what does Mr. Buffett say about diversification? Although Buffett has favored concentration in certain aspects of his investing career, he still continues to prioritize quality over quantity. Buffett suggests that you should not go overboard with diversification. If you're an investor who only invests in businesses that you understand well, then worry not, dear friends, you're in for a treat. Number 5, be patient. Patience is a key characteristic of Buffett's investment approach. Guys, this point is just an extension to the one we discussed earlier about long-term investments. Along with helping in the process of long-term investment, patience also helps you avoid hasty decisions based on your emotions. When you're patient with your investing process, it will also help you to learn from the mistakes that you have made in the past. Number 6, the margin of safety. In literal terms, the margin of security refers to the difference between the intrinsic value of a stock and its market price. When you buy a security with a good margin of safety, it will help you to protect yourself against potential uncertainties, thus reducing the risk of significant losses. When you take the margin of safety into consideration, it will also act as a buffer stock in case the actual intrinsic value of the investment turns out to be lower than your initial estimation. Number 7, avoid the herd mentality. Warren is a firm believer in independent thinking and avoids blindly following a crowd. By avoiding herd mentality, you will be able to focus on making clear and rational investment decisions based on your own analysis instead of getting distracted by the noise of the market. You will often go against market trends when you learn to avoid the herd mentality. This will help you see more buying opportunities in situations where other investors are fearful and selling. Number 8, control your emotions. Controlling emotions is one of the most important psychologies that can be learned from Warren Buffett. He's known for his emotional discipline and ability to stay calm and rational during market fluctuations. When you learn to approach the markets with calm composure, you understand that market downturns are inevitable. This understanding reduces the shock and disappointment that an investor who is not in control of their emotions might face. Also, emotionally driven investors may, instead of focusing on the fundamentals of the businesses they are investing in, focus on the short-term price movements of the investments. And this is something we have to avoid in order to become successful investors. Number 9, be greedy when others are fearful and be fearful when others are greedy. Have you ever noticed how a local market works? When demand is high, the prices of the products increase, and when there is low demand, the prices fall tremendously. In the same manner, the market works in a cycle of greed and fear. People are willing to pay more than a business is worth when there is greed. But when dread creeps in, excellent companies are offered at discounted prices to everyone willing to put their negative feelings aside. So you will have to seize and learn the opportunity. Warren Buffett's stock psychology is not just a set of rules for investing. Rather, it provides us with the overview of his character, wisdom, and the value he embodies. Through his approach to stocks, we learn that successful trading is not about quick gains, but rather about patience and discipline. If you're a book reader, then we suggest you read the 3 books which is mentioned in the description for more enlightenment on the following topic. Friends, don't stress. There are plenty of prospects for one to succeed in this dynamic world of investing. All you have to do is keep things simple. Don't hesitate to step out of your comfort zone, but make sure that your steps are calculated and not hasty. That was it for today's video. We hope you enjoyed it. Stay tuned for the next update. Until then, keep learning and growing.